This is Greg Patterson of the Advisor Group, and welcome to our quarterly context webinar for the second quarter of 2016 for clients of the Advisory Group and WealthStep. WealthStep is the division of the Advisor Group that provides a simplified service for up-and-comer clients of a smaller size than our traditional clients. The quarterly context webinars are designed to provide some high-level perspective regarding the economy, markets, investor behavior patterns, and other elements that are helpful to people in terms of achieving their goals and maintaining a long-term perspective. And we'll try to keep this meeting to 20 minutes or so, and we will also circulate a video link afterwards should you like to review some segment of it again or to pass it on to someone you think might find it helpful. If you have any questions, please submit them to the question box, and we'll either address them as we go along or at the end of the presentation. So as a high-level reminder, we always emphasize focusing first on your most important goals, keeping that as your primary objective in light of and despite volatile markets. The planning process, whether you're an individual or an institution, is designed to help you develop a path towards that goal, and varying from that strategy can affect your outcomes. If any of your objectives have changed, then please contact us. We can help potentially modify your strategy to help you achieve your desired outcome with the potentially with a lower level of risk in some cases, if the objectives have changed. As a market and economic overview, as always, things are interesting. The most standout news from the quarter was Brexit. That happened right towards the end of the quarter on June 23rd. If we look at markets here, we'll come back to that in a moment, and if we look at markets here at the top of this busy chart, you can see the overall world market was up somewhat tepid amount at 1.2%. U.S. stocks were up better than some would expect given the Brexit element, although at 2.5% that is. And in some level there was and has continued to be an element of flight to safety or perceived safety of U.S. stocks relative to European stocks. That's an interesting dynamic because it may be overinflating U.S. stocks a little bit relative to European stocks, which may be more exceptional values and interesting opportunities. Small companies were up 3.8%, so smaller cap in general did better than large cap for the quarter. International was down 1.5% given the Brexit concerns and general uncertainty surrounding that. Emerging markets was semi-flat at 0.8% for the quarter. However, for year-to-date had some of the best returns across equity markets at 6.4%. Part of what held back that year number at negative 12% was the last July return, including China, which was down 14%, and China is a large part of the emerging markets index at about 25%. U.S. bonds were up at a very solid level. That's about an 8% annualized return, or approaching 9%, so that's higher than we would expect for bonds for a quarter, and international bonds even more so, and bonds were pushed up essentially because of flight to safety and flight to quality given the Brexit elements. As we can see here in the middle, volatility has picked up during this Brexit time towards the end of that quarter, and has subsided a little bit, but we would expect volatility to remain at higher than long-term average levels given the uncertainty around, again, Brexit. In terms of style, we've talked about the market elements there. Style, value beat growth pretty much across the board, so value is continuing to make a bit of a comeback after being out of favor for a couple of years. Fed rates were left where they were at about 0.5%, given the Fed had originally planned to leave it at that same level, but then confirmed that after the Brexit situation. Several of European governments and some others have been continued to be stimulative in their approach, keeping rates low or lowering them further, and some other bond buying programs, somewhat a la the U.S. Quantitative easing approach. So adopting some of those strategies later, if they adopted them sooner, they might be in a situation that's a little more close to the U.S. type recovery. Inflation remains low, with the measures in the 1 to 2.2% range. Some have concerns that that's not sufficient inflation and relates to insufficient growth. And GDP related to growth was revised upwards a little bit. A little bit of growth momentum occurred there, revised upward to 1.1 from 0.8, but still that's less than half of 2015's growth level. Jobs weakened a bit, so even though the job number went down, which means that unemployment shrank, or theoretically it would appear that there were more jobs or more hiring, that's primarily been to fewer people seeking jobs in the shrinking labor force. Wage growth did increase just slightly, however, from the prior quarter up to 2.4%. So purchasing, that if that flows through to the economy, that could be helpful, but the unemployment is still getting in the way a little bit, although 4 to 5% is not a horrible level, though some would suggest that it's a few percent higher than that when you adjust for people who have stopped looking. Oil has continued to rise. It was one of the strongest performers for the quarter, up about 25% to $48. And as you may recall, we talked about how that Saudi Arabia would really like to have the oil in the $50 to $70 range at a minimum to maintain their economic stability. And so, interestingly, it's floated up to around the lower end of that range. There are always the geopolitical wild cards, and the last comment would be that in addition to oil, commodities in general were one of the strongest performers, given some bounce back after having depressed prices, with the most commodity indexes up around 13%. Gold was up 7% and 25% year to date. So year to date, that was one of the strongest performers. However, recall that gold in the long run does not even beat inflation. So at the short-term fear asset can have a few spikes, but don't let the shininess of gold be too distracting, because it doesn't pay off in the long run. And of course, it's hard to guess when markets will shift. Rather, it's impossible. In terms of economic metrics, talked already about unemployment and wage growth. Labor force has cooled off a little bit in terms of participation. It's interesting to see now on this chart how it shows that aging is one part of that, cyclical is another, and other, which is the general disappointment and the perception that it's difficult to find a job, as one of the primary drivers of that other category. Gives you a sense about what is driving that the movement over time in the participation rate. Inflation remains low. As discussed before, the Fed would like to see that pick up a little bit, actually. Overall consumer sentiment has been hovering around a relatively healthy level, up a bit slightly and then cooling down a little bit related to the Brexit question at the end of the quarter. And we already talked about oil here. If we look at the 4 bad bears chart, we can see where things stand now. The blue line here, again, this is the larger chart here is after inflation. So these are returns you can actually eat, versus the smaller chart here, which is before inflation or nominal returns. So these real or after inflation returns are the more important measure to look at in terms of a recovery, in terms of how it really affects people. The blue line is the global financial crisis and recovery. Continues to remain above the other 4 worst markets. However, as you can see over the last several hundred days, it's been bumpy to flat, which is roughly what we would have expected and have been talking about, given that the markets just can't go up at that rate for forever. And if we move this blue dotted line up a little bit from where it was in the past, if we move this up to about 1/3 up the starting point from the market crash, as an estimate of where maybe a reasonable starting point is for a long-term average projected stock returns, this would suggest that this sideways market was approaching a reversion to the mean, and that might be about 200 market days away. Again, this is not a prediction. This is just a sense that, or a summary that we're heading towards over time more normalization of market returns. So some of the weak markets that we've seen in the last year or so is just part of the normal process. If we look at valuations, continue to be above the 10-year averages, but not at the much higher levels that they were even just a few quarters ago. The most interesting case is maybe emerging market stocks that has the lowest relative valuation, maybe around average, but has actually been one of the best performers in the last 6 months. So that's an interesting combination of maintaining relatively attractive valuations and strong performance. If we look at the quality thermometer for the quarter, we can see for the year where you see green numbers and positive numbers, that means that higher quality stocks outperformed lower quality stocks. You may recall that during the post-global financial crisis market, there were several years where most of this was red, more speculative, hot type markets. Now with markets becoming a little more normal and bumpy, that's where higher quality stocks tend to shine, and then client portfolios, we incorporate managers that, in part of the portfolios, that managers that, active managers that include focus on higher quality stocks, which can dampen the downside in difficult markets while having essentially the same or similar long-term average return. So that can provide a little bit of risk control within at the manager structure portfolio level. More recently, overall, it looks like there's more green and neutral than red here, but the bigger negative number here means that growth in particular had lower quality jump out ahead of higher quality, and because of the magnitude of that number, the overall U.S. stock market had a little bit of a lower quality bias in the second quarter. If we look at the reality of red bonds, the concerns about Brexit, you can see how that caused the month of June for the U.S. bond market to jump almost 2%, pushing up year to date through half a year at 5%, which is a couple of percent over the projected full year return for a 10-year period. However, that may not stay that way forever. Eventually, rates will have to rise. Certainly, we've been saying that for a while, but that's the way markets work. And when the flight to safety, concerns about flight to safety wane, we may see some more normalization, especially as rates rise. In terms of one area of value added that the advisory group helps with our clients is helping people maintain a disciplined investment approach despite bumpy markets, to stick with their strategies. Clients who have seen multiple market cycles over time and have seen the rewards of sticking with their strategies despite times like Brexit, despite the global financial crisis. And even though those moments can be challenging, and Brexit is currently not nearly having the impact that some thought it might have, so it's turning out, at least currently, not to be a major market pullback. But maintaining a discipline can make a real difference. This chart shows an example of that, where over the last 15 years, someone that was fully invested and had an average annualized return of 5.8%. That may not seem like a high return, but that was the market, and that includes the second and third worst market in history. Also recall that inflation has been unusually low, so if you subtract inflation from this number, the after inflation returns are actually not dramatically different, a little lower, but not dramatically different than long-term averages. But if you take out the best 10 days of those 15 years, your return would have dropped to 1.2%. If you take out the best 20 days, you actually end up with a negative 1.7% return. And if you take out the best 30 days, negative 4%. Take out the best 40 days, and it would be a negative 6% return over a 15-year period. So this is an illustration of how important it is to be in it to win it, despite the volatility. If you miss some of the best days, which are oftentimes bounce backs from some of the worst days, it can really damage accounts and therefore goals and dreams, whether you're an individual, a foundation, an endowment, a plan participant, or a fiduciary overseeing any of those. So you can see the asset values change, starting with 10,000 here, how that would have ended up, so a powerful illustration. Here, we thought we would highlight a discussion or an outline of a typical evolution of asset allocation. This does not apply to trustee-directed static asset allocation retirement plans or most foundation endowments, but more towards individuals in 401k plans or individuals that we work with directly. This is an example of what's called a target date fund that we build on a custom basis in the green line here, where stocks automatically and gradually reduce over time. This is partly modeled after, and the custom designs that we've done is partly modeled after our experience with individual direct clients on the personal wealth and life strategy side of the advisor group. And the numbers and the calculations that support the idea of taking enough risk in the stock market early on so that you can take less risk later in life and so during your spending years, so that you're not spending during high volatility periods. Certainly some individual clients have patterns that are very different than this because of different risk profiles or different needs or in relation to their assets. But this is an interesting conceptual way to visualize that. Generally, people can, should, and would reduce their stock exposure over time. And if they've planned for long enough and well enough, then they can afford to do that and afford to have a little bit less return in their later years because they would have prepared for that appropriately. In terms of the mutual fund industry cash flow chart that we normally show, we can see some of the patterns here. Some pulling out of money recently out of the domestic market and into bonds primarily. Also money still coming out of, a lot of money coming out of money markets given the low returns. And guess what? As people pump that into these markets, that's been a little bit helpful and lucky in the short run with bonds, but people are pumping money into bonds over a full cycle are likely to be disappointed when rates rise and when equity markets regain stronger footing. So the long-term pattern here, as always, is people tend to, the average retail investor tends to, and some institutional investors tend to move money at the wrong time, chasing returns, really like driving in with the rearview mirror rather than being forward-thinking on a strategic basis. In terms of our asset class corner for the quarter, we thought we would highlight what mutual fund revenue sharing is. This is a term that you might have heard about, but may not know much about or might not have ever heard of. Revenue sharing is a term that relates to a portion of the fee that investors pay to a mutual fund. That fee we often refer to as the expense ratio. A portion of that can be rebated back to certain entities. If some of those entities include certain types of retirement plans and to environments where there's a broker who can collect that as a fee. The advisor group does not collect those fees, and anywhere possible, we try to have those fees rebated back to our clients. Those fees are not, it's not possible to have that rebated back to individual clients, foundation endowments, and certain retirement plans. And generally, these revenue sharing components, which are oftentimes technically referred to as a 12B1 fee, when we do our fund research, generally we are avoiding funds that pay that altogether because it generally is just leading to a higher expense ratio so that those funds can afford to pay that out. What's interesting is that on occasion, we'll have a relatively low-cost fund that we think from our research merits utilization, and if they have just one share class or maybe the lowest cost share class because mutual funds typically have different share classes from institutional to retail expense ratios, so they can charge different people different amounts, and we help our clients access the institutional shares. Sometimes there's an institutional share class that still has a small amount of revenue sharing, so we won't necessarily avoid a fund just because it has that, because it may still be low cost, a very low cost fund, and a fund that merits consideration. But in some cases that revenue sharing, if the client isn't of the type that can capture it, then it's retained by the mutual fund company, or in some cases the custodian bank will keep that, and this custodian banks essentially design their fee schedules around, based partly on estimates of how much revenue sharing they will capture. So it's a little bit confusing if you're not familiar with this world, but you know, sort of the underbelly of mutual funds. But the important thing to note is, if you and we are focused on maintaining the lowest cost structure possible, it's important to be aware of how that works, but it doesn't influence our process at all, and it doesn't tend to have a big cost impact because we use low-cost funds that generally don't have revenue sharing. There are some plan sponsors that will actively select or ask for higher cost funds in order to have more revenue sharing to offset their plan costs. That's not necessarily a problem, but it depends on whether or not how that's disproportionately affecting the participants within the plan. So it needs to be justified carefully. In terms of a quick 401k focus, there was a recent Callan 401k or DC survey that supports a lot of our common best practice ideas, that the key elements to helping people, and this applies to whether you have kids that are not in a 401k plan, or you're a 401k participant, or even a young individual who's in the saving mode to try and build your wealth. The savings rate or contribution rate is absolutely critical. Being involved in doing that and being invested in and saving is key, and then having a cost-effective structure. And then some of the big patterns that have shifted over the last 10 years after the Pension Protection Act have been that plans are, and this is consistent with a number of our clients, have increased automatic enrollment, more are doing re-enrollment, which means they will periodically start from scratch, even with the same plan and investments, and reinvest everyone to make sure they're in something that's relatively appropriate for their age and their situation, and then the participants can simply opt out. And then some are increasingly automatically enrolling and auto-escalating savings rates for people to essentially, with positive paternalism, force people to save more. And what's interesting is that most people don't complain about that and are glad that it happened, because a lot of people simply don't save just because they don't focus on it and aren't aware of what to do, how much to save, or how to do that. So a few points there. Not a whole lot to cover in the rules and regulation corner. If you are a retirement plan that has needs to collect late restatements, or an issue related to Roth and the allocation rule, or have a modified determination letter issue, you may want to reach out to us, and we'll have one of our specialists in that in those areas talk that through with you, and make sure you're getting the right support to address those some of these regulatory shifts that might help with those elements. With that, we'll conclude. We first want to thank you for being clients and friends of the advisory group. We are always interested in knowing how well you feel supported and how we can do better, so feel free to call us if we haven't already talked about that with you recently. We are always interested in ideas about how we can do better and to meet your needs, and whether it's information, support, analysis, or whatever it might be. Whenever you have others that you feel like we can help, like we've helped you, we certainly appreciate those introductions, because the bulk of our growth comes from client referrals, and those are always very much appreciated. So with that, we'll conclude the meeting and start to take a peek and see if there are any questions. So thank you, and we look forward to talking to you soon.